In this week's video, we'll cover 6 new stock market signals to see what we can learn about the market's risk-reward profile. We'll begin with the new signals and studies, and then we'll link back to an S&P 500 chart dated December 11th. Signal number 1. This is a breath indicator tied to the NASDAQ. You can pause your video player. There's a little blurb about the indicator at the bottom of the screen. And as you can see, a very rare and extreme reading came near the low in 1987. The only other time we've seen something similar, 2020. Thus, we can make an argument that April 20th of this year was very, very similar to January 7th, 1988. And if you know your market history, the S&P 500 made its final bottom in December of 1987. Thus, from a longer-term perspective in the present day, it might be helpful to know, how did the S&P 500 perform walking forward from January 7th, 1988? The answer is extremely well. A very muted drawdown and an extremely satisfying long-term gain between 1988 and the spring of the year 2000. Signal number 2. Similar situation here, breath indicator this time tied to the NYSE composite. This is weekly new highs minus new lows going back to 1981. Similar situation here, very rare reading near the low in 2008. A very, very similar reading near the low in 2020. Only 2 times in the last 40 years have we seen this indicator move from levels down here back up to the upper blue line, after the major low in 2008 and after the low in 2020. September 18th, 2009 is similar to December 4th of 2020. And right out of the gate in the 2009 example, there was a 4% give back, helping us keep an open mind about a wide range of outcomes. But from the date of this signal, September 18th, the S&P 500 eventually tacked on an additional 13.95% over the next 217 calendar days. But all of that rally was given back, and we eventually fell below the September 18th level. 287 days from September 18th, that's calendar days, we were 4% lower, which helps us respect that we could be in the Nordique phase of this bull market, something that we covered in detail last week. Since our time frame is longer term, it might be helpful to know what happened walking forward from September 18th, looking out several years. The answer is the Nordique phase was soon forgotten. The S&P 500 tacked on an additional 99% from the close on September 18th until the spring of calendar year 2015. Keeping in mind that September 18th of 2009 is similar to what we just saw on December 4th of 2020. Signal number 3. Also a breath indicator, this time tied to the NASDAQ. This indicator shows us the percentage of NASDAQ stocks above their 200-day exponential moving average. Once again, pretty rare to go from the lower blue line to the upper blue line. It's only happened 2 previous times, January 16th, 2004 and January 22nd, 2014, similar to something that we just saw in 2020 on December 8th. In the 2 previous instances, S&P 500 performance, a mixed bag looking out 23 calendar days, which would basically take us to year end in 2020, a mixed bag looking out 2 months, 3 months, and 6 months. However, in both cases, the S&P 500 was substantially higher. 3 years later, the average gain was 24.32%. The left side of the table helps us keep realistic expectations about 100% normal and to be expected volatility. And understanding what the maximum historical drawdowns look like can also help us get to the right side of the table or keep a longer-term focus. Relative to history, it's a 2020 chart dated December 10th. Wouldn't be shocking to come back to this level here below 3,500 even before year end based on history. And over the next year, in a possible Nordique scenario, we might come all the way back to around 34.50-ish. And as we walk through these signals, it's important to keep in mind, technical analysis tracks the past. It does not predict the future. We have to use our own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. Signal number 4. Sticking with market breadth, a breadth indicator tied to the NYSE. This is the Swindling Breath Momentum Oscillator. Have data here going back to 1981. Only seen a move like this 7 previous times in the last 40 years. Taking a look at S&P 500 performance after the date of this signal, which would be similar to this point here in 2020, or month end November 30th, 2020. Historically, good things happen for a long period of time. 100% of the cases higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Worst case scenario, 5 years later, a gain of 52%. Average gain, 93% looking out 5 years. Historically, if you wanted to get to the right side of the table that we just looked at, the maximum drawdown over the next month was less than 4%. The maximum drawdown looking out 1 year, less than 7%. Average drawdown less than 1% over the next month, and less than 2% over the next year. The drawdowns are calculated walking forward from the date of the signal, which would be similar to the S&P 500's close on November 30th of 2020. Thus, we have something rare that just happened in 2020 at the end of November that tells us as long as the data that we have in front of us remains constructive, we can maintain a longer-term focus. And in the wake of the 1987 crash, it wasn't necessarily a volatility picnic looking out 1 to 6 months, helping us keep those all-important realistic expectations. Let's zero in on the 2003 case and the 2009 case. Those two cases also share something extremely rare relative to human behavior. You can pause your video player. Signal number 5. It's a weekly chart of NYSE stocks greater than their 200-day exponential moving average. Extremely rare oversold condition near the low in 1987. Rare oversold condition near the major low in 2009. Only 3 times, going back to 1986, have we seen something similar. The third one, near the major low in 2020. And only 3 times have we moved from the lower green line to the upper green line. And in the 2 previous cases from the date of the signal, the S&P 500 was higher 1 year later, 2 years later, and 3 years later, with the average gain looking out 3 years, somewhere in the neighborhood of 43%. If you look at this chart in more detail, it's pretty easy to see this case here is much more similar to the present day relative to this case here where it takes years to get to the upper green line. And after this case here, S&P 500 returns were a little more stable. How about maximum drawdowns? Pretty big one in the 1997 case, over 9% over the next month. 2009 case, a little bit over 4%. Looking out 1 year from the date of the signal, very, very similar numbers. What would that look like on a present day chart? Tells us over the next month, it wouldn't be shocking to move back to this line here or this green line here. And historically, investors that were able to keep their cool during those volatile periods, they were rewarded in a big way. And the right side of this table, if you look at it more closely, gives us a prime example of what the Nordique phase looks like in the real world. Notice in 1997, 6 months later, you were up 14.83%, and then a year later, only up 3.89%. That's your Nordique phase, where from the present day, we could get a nice gain, 14%, and then we could have a fairly substantial give back. Not a prediction, just one of many possible outcomes. Signal number 6. Similar breadth indicator, this one tied to the S&P 500 stocks greater than their 200-day exponential moving average. This is an extremely rare move from a rare oversold condition all the way back up to the upper blue line. Might be helpful to know how the S&P 500 performed walking forward from the date of the signal in 03, 09, and 2013. The answer is quite well. In all three cases, the market was higher 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. Worst case scenario, 4 years out from the date of the signal, a gain of over 35%. In this case, the historical drawdown's relatively muted. And in the short run, it tells us even before year end, historically, it wouldn't be shocking if we followed a similar path. In one case, we could drop as low as 35.50 on the S&P 500, helping us keep an open mind about a wide range of outcomes in the short run, even if it turns out that good things happen for a long period of time. Let's quickly take a closer look at the 2003 case. Walking forward from the date of the signal in 03, the S&P 500 tacked on an additional 42.8% before the peak in October of 2007. And looking out several months, we have an example of the Nordique phase. Notice at this stage of the rally, for the most part, price stays above an upward sloping 200-day moving average shown in red. Let's take a closer look at the 2013 case, which is similar to December of 2020. After breadth reached a similar point on April 11, 2013, no significant Nordique giveback here, a very, very strong trend. Price stayed above the 200-day moving average for the most part for over 2 years, and the S&P 500 tacked on an additional 33.73% before peaking in May of 2015. How is it possible that a stronger trend or something like this could happen over the next 2 years? Well, this is what the last 3 years look like for global stocks. Not a lot going on. This is consolidation. We can draw horizontal lines and hit price several times. That's quite a bit different from this 2-year period here. Also noteworthy relative to global stocks over the last 3 years. Price was originally bounded by this green box here at point A. This looks different from this at point B. We clear that level and hold above it for a little while. Similar situation here. After this breakout at point B, we're bounded by the blue line. Present day looks a little bit different. In this case, we were able to clear the blue line twice. Now we've rallied back above it and we're holding. This is a subtle shift, but right now it's a bullish shift. We also know that a failed breakdown look and a reversal can be very, very bullish. And since the reversal, we've had a lot of confidence in white space down here, and the consolidation has taken place above the 200-day moving average. We appreciate our loyal clients and loyal viewers, so we threw in a bonus study this week. We covered this chart in a little bit more detail last week. This week, World Financials Index, trying to nail down a bullish MACD cross in the monthly chart this month, with the cross coming below the center line. Using all of the data that we have, it's only happened 5 previous times. In each case, the market was higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Worst case scenario, 5 years out, a gain of 45%. Average gain 3 years out, 40%. Also noteworthy, in every one of these studies, it's not just the bullish and positive setup or the bullish look. If you look at the data that we have in hand, the present day really doesn't look anything like this peaking process here. MACD is well above the 0 line, and we get a bearish cross. The S&P 500 doesn't peak until October of 2007. This really doesn't look anything like this, where momentum is turning up below the zero line instead of turning down above the zero line. The same can be said for all of the charts and studies we've covered this week. It's relevant that they look like bullish setups in the past. It's also relevant that they don't look like bearish setups in the past. Now let's see how all of this can help us better understand the chart in front of us. It's a daily chart of the S&P 500 dated December 8th. This is the recent high. We'll take all of this and see how it's helpful on Friday, December 11th. This is the recent low in the S&P 500 in late October of this year, and this is the sharp rally that ended at point B in the upper right-hand corner of your screen on December 8th. There's a cluster of relevant guideposts, bull-bear guideposts, in this basic area here. This is the 38.2% retracement of that A to B move. This is the 50% retracement here where my cursor is, and this is the 61.8% retracement. All of the slides that we've covered previously have shown the S&P 500's 50-day moving average in blue. On December 8th, that was around 3,500. The previous slides have also shown the 200-day moving average in red. On December 8th, that was sitting at roughly 3,164 down here. This downward sloping thin dotted blue line here shows the breakout in early November. You can see thus far we never really retested that line. That's not a requirement in any shape, form, or fashion, but if we do move backwards with the uncertainty in Washington, D.C. right now, this also could be a relevant guidepost. Now let's take the same chart and fast forward to intraday on Friday, December 11th. Now the 50-day moving average in blue is sitting at roughly 35.18 and the 200-day in red at 31.74. This is the look of the S&P 500 when it was down 20 points intraday during Friday's session. Moral of the story, wouldn't be shocking based on history and what's happened recently in 2020 to see the market pull back to 3550-ish. Wouldn't be shocking to come down into the 3400 area. And I would say that's probably the base case for the worst case scenario based on what we know today. Outside of that base case, history also says a move all the way back to 3360 wouldn't be shocking. And like all market guideposts, we learn something either way. A move coming back in this direction that bounces in this area would probably fall under the normal and to be expected category. If we take out this 61.8% retracement level here where my cursor is, or we break below this downward sloping trend line, concerns would start to increase. Any sustained move below 3360, we would learn something about increasing bearish probabilities. Nothing says any of this has to happen. Here's the text from last week's video, and all of this seems to still apply. Said it wouldn't be shocking based upon what we covered last week to see a quick 5% pullback in the S&P 500 index. That would put us into this range here. We also covered in detail last week that in 1995, with a similar profile, we came into somewhat of a never look back scenario where the market continued to rally. All of this just helps us keep an open mind about a wide range of outcomes. Having bull-bear reference points can help us remain calm and understand bull-bear probabilities during pullbacks. And if we pull back into this area here, it's the weight of the evidence that we'll be looking at. How are the credit markets acting? How is the VIX acting? How about asset class behavior? What about sentiment readings? It all factors in. We do know we have uncertainty in Washington in the short run, and we had extended sentiment up here, telling us that it's prudent to have some type of probabilistic understanding about what could happen if we pull back. Also noteworthy, we covered the Swindling Breath momentum oscillator earlier in the video. Notice these oversold conditions are the green boxes. They all occurred near very, very constructive lows in the S&P 500. In each one of the historical cases, if you were able to think longer term and look by the day-to-day volatility, it worked out pretty well. None of that is a prediction about the future. It simply helps us understand the probability of good things happening relative to the probability of bad things happening. And in the historical cases, as we've already covered, good things happened. How is any of this possible? You can pause your video player here, but there's a lot of money in the system. Pause your video player here. Recent study from UCLA. The next few years will be roaring. Do the credit markets seem to agree? Right now, the answer is absolutely positively yes. Spreads near the lower end of the spectrum. This looks like credit confidence, not like increasing fears of bond defaults. It's quite possible that the stock and bond market sees this look converting into something more like this in the weeks, months, and years ahead. Fair question might be, why don't we always just trade the chart in front of us? Well, we should do that. The historical studies and signals help us understand how to trade the chart in front of us. Meaning, every drop below the 50-day moving average, those are not created equal. Every drop below the 200-day moving average, not created equal. Context matters in terms of how you handle it. The tables that we covered this week help us keep realistic expectations about volatility in the short run. They also help us respect that longer-term outcomes could be much better than expected. And we know when we ask the question, does all of this on the screen align with or contradict everything that we've been covering since early April of this year? We know the answer. In summary, based on what we know today, longer-term odds remain favorable. Drawdowns historically typically fell under 6% from current levels. Based on what we know today and based on history, we'll be managing against a strong trend secular standard, which means we know what we're looking for. If we don't get it, we'll learn something. We have to respect the possibility of Nordique givebacks over the next 1 to 2 years. And as always, we'll take it day by day and we'll trade the chart in front of us. And the only way that we can do that properly is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.